Welcome back to the deep dive. Today, we are putting a Canadian giant on the operating table.
Uh-huh.
We're looking at a financial institution that is, well, it's currently in the middle of what looks like a very expensive, very high-stakes identity crisis.
It's a good way to put it.
We are talking about the Bank of Nova Scotia, better known to everyone, of course, as Scotiabank.
It is definitely one of the most complex and, frankly, one of the most fascinating stories in the Canadian market right now.
It really is.
It's a bank that is trying to change its DNA in real time.
And just to set the scene for everyone listening, let's check our watches. It is February 8th, 2026.
Right.
The snow is likely piling up in Toronto, and we have the full fiscal 2025 scorecard in front of us.
And not just a scorecard. We've got a stack of research notes from Morningstar, primarily looking at the analysis by their equity analyst, Mao Chen.
Exactly. We're pulling from a whole range of his reports. Everything from those early 2025 risk assessments when the tariff scare was hitting, all the way to the most recent earnings analysis from December.
So we have the full picture.
We do. And the reason we picked this topic today is that Scotiabank is trying to pull off a magic trick. They are trying to transform from Canada's international bank, you know, the adventurer in the jungle.
Right, the one that planted flags everywhere.
Into a fortress of the North American corridor.
That is the branding pivot, right? For decades, if you owned Scotiabank stock, you owned it because you wanted a piece of the emerging markets.
You wanted that growth.
You wanted growth in Colombia, Peru, Chile, maybe the Caribbean. You were okay with a little volatility because the ceiling, it felt so high.
Right.
But under the new CEO, Scott Thompson, that map is effectively being shredded. They are exiting the jungle and try to pave a superhighway from Mexico City to Toronto.
But here is the tension, and this is really our mission for this deep dive. Is that highway actually safer?
A very good question.
We are looking at a bank that is trading around 96 Canadian dollars right now. But Morningstar, in these reports, thinks it is only worth about 78 Canadian dollars.
Yeah, it is a massive gap.
It's a huge gap. So we need to figure out if the market is seeing a turnaround that the analysts are missing, or if investors are, frankly, walking into a value trap.
To do that, I think we have to look at three big pillars today.
Okay.
First, we need to look at the quality of earnings, because the headline numbers for 2025 are a bit deceptive.
I suspected as much.
Then we really need to dissect this concept of an economic moat. Why does Scotiabank have a fortress in Canada, but basically a tent in Lima?
A tale of two banks.
Exactly. And finally, we have to talk about the macro risks that could blow up this new corridor strategy, specifically tariffs and the Canadian housing market.
Okay, let's do it. Let's unpack this. Let's start with that report card. Fiscal 2025 is in the books.
Right.
If you just read the press release or maybe saw a headline on a financial news ticker, you probably felt pretty good about it.
Oh, for sure. The top line numbers looks great.
So adjusted earnings per share, or EPS, for the fourth quarter hit, what, 193?
CAD 1.93. And that's up 23% year over year.
23%. I mean, in the world of boring Canadian banking, 23% growth is usually cause for champagne.
It sounds fantastic. If you have a portfolio of blue chip stocks and one of them pops 23% in earnings growth, you are usually thrilled. You're thinking about retiring early.
Right.
And looking at the full year, their return on equity, the ROE, came in at 11.8%.
Which is an improvement.
It is an improvement. It's up 50 basis points from last year. So
Yeah.
purely visually, the arrow is pointing up.
But I hear a very significant but coming in your voice.
There's a massive but. The bank's medium-term target for ROE isn't 11.8%. It's 14% plus.
Ah, so they're still way off the mark they set for themselves.
They're still significantly missing their own goal. And when you peel back the layers of that onion, you realize that this growth didn't come from the core business.
What do you mean by that?
I mean, banking at its most basic level is I lend you money, you pay me interest. That's net interest income. That is the bread and butter. That is the protein of the bank's diet.
Okay.
That part of the business was actually struggling.
So if the protein wasn't there, where did the money come from?
It came from the sugar.
The sugar.
The volatile stuff, the fun stuff, capital markets. The growth was driven almost entirely by fee income.
Ah, so not from lending.
Not from lending.
Yeah.
Global banking and markets, that is the investment banking, trading, underwriting arm, was up a staggering 50% year over year.
50%. That is an absurd number for a bank of this size. That sounds like a tech startup number, not a big six bank number.
It was a perfect storm in the best way possible for that specific division.
So what happened?
Well, think about the environment in late 2025. Interest rates were finally stabilizing.
Right. The market could breathe a little.
Exactly. Companies that had been sitting on the sidelines rushed to issue debt before things changed again. M&A activity, mergers and acquisitions, that picked up.
So the deal makers were busy.
Very busy. Underwriting and advisory fees were up 37%. Trading income was up 21%. Scotiabank's trading desks were just printing money.
And what about the other fee-based business, wealth management?
That was also strong. Earnings up 18% year over year. So you combine that with the capital markets boom.
And you get your sugar rush of fees that save the quarter.
Exactly.
Yes.
It is high calorie, but it burns off fast.
Meaning you can't count on it?
You cannot count on a record year in trading every single year. It is cyclical. It depends entirely on the mood of the market. If the market freezes up in 2026, or volatility drops to zero, that 50% growth evaporates overnight.
Okay, so that's the sugar. Let's look at the protein of the diet then, the actual lending.
Right, the core business.
How did international banking and Canadian banking perform? Because that's where the stability is supposed to be.
Sluggish is the word I'd use.
Sluggish.
International banking was up about 6%.
Yeah.
Which is, it's fine, but it's not earth-shattering, especially when you factor in the inflation rates in some of those countries.
So in real terms, maybe not even 6%.
Maybe not. But the real shocker was Canadian banking, the supposed engine of the bank, the fortress we're going to talk about later.
The crown jewel, what was it?
It was up only 1%.
1%. With inflation running at what, 2 or 3%? That means, in real terms, the Canadian business effectively shrank.
It went backwards, yes.
Why? Is nobody borrowing money in Canada? I find that hard to believe.
Well, people are borrowing, but the bank is getting very worried about getting that money back. 2 words, provisioning expenses. This is the dark cloud hanging over the entire 2025 results.
Let's clarify provisioning for the listeners who might not speak accountant. This is the bad debt jar, right? You're setting money aside for loans you think will go sour.
That is the best way to visualize it. When a bank lends money, they can't just assume everyone will pay it back. They have to estimate how much of that money is never coming back.
It's an expense they take now.
Right. They take a charge against their earnings today for loans that might go bad tomorrow. It is called PCL provision for credit losses.
And that number was big.
It was huge. In Q4 alone, Scotiabank had to set aside over $1 billion.
$1 billion.
With a B, yes.
That is $1 billion of profit just taken off the table, put into the jar.
Vaporized from the earnings statement. And to put it in context, for the full fiscal year 2025, that provisioning was 54 basis points of their average loans.
Okay, 54 basis points. What does that mean in plain English? Is that high or low?
It's very high. In a happy, healthy, growing economy, you'd expect that number to be around, say, 20 or 25 basis points.
So it's more than double what you'd see in the good times.
The cost of risk has effectively doubled, yes.
And this is the hangover from the high interest rate environment, isn't it? The chickens coming home to roost from all those rate hikes?
Precisely. It is the lag effect. Rates went up in 2023 and 2024, but people burn through their savings slowly. Businesses hold on as long as they can. By 2025, the cracks started to show.
So you're seeing it in things like credit card delinquencies, mortgages?
All of it. Whether it is a Canadian homeowner with a variable rate mortgage hitting their trigger rate, or a small business in Mexico whose input costs have soared, the borrowers are squeezed. The bank sees that stress and has to prepare for the worst.
And the guidance for 2026 suggests this isn't over. They aren't saying, okay, we filled the jar, we're good.
No, not at all. Management was very clear on the earnings call. They expect provisioning to stay in the high 40s to mid-50s basis points range throughout 2026.
So that $1 billion hit per quarter, that is the new normal for now.
That's the baseline they're telling the market to expect.
Okay, so to summarize the scorecard for 2025, the headline growth looks fantastic, but it is fragile.
Very fresh.
It's built on a boom in investment banking fees, which might not repeat, while the core lending business is being weighed down by a $1 billion anchor of bad debt provisioning.
That is the perfect summary. And that fragility is exactly why CEO Scott Thompson is trying to overhaul the entire strategy.
He knows this isn't sustainable.
He knows he can't rely on a trading boon forever. He needs to fix the structural problems. He needs to build a better boat, not just hope for good weather.
Which brings us perfectly to part 2. The pivot, this shift from being a Latin American adventure to this North American corridor strategy.
Big change.
Scott Thompson isn't a traditional bank lifer, is he? His background is different.
No, and that is so important to understand the psychology here. He came from Finning International, which is the world's massive Caterpillar equipment dealer.
So he sells tractors, not mortgages.
Exactly. He views the world through a lens of capital allocation and operational efficiency, not necessarily banking tradition. When he looked at the map of Scotiabank's operations, he didn't see glory in being in 30 countries. He saw inefficiency. He saw dragged returns. He saw complexity.
The old strategy under Brian Porter was essentially flag planting. If it was an emerging market with a growing middle class, Scotiabank wanted to be there.
Right. And the theory was sound on paper. Canada is a mature, slow-growth market. If you want fast growth, you go to where the population is young and unbanked Latin America.
But the execution was messy.
Very messy. They ended up being a small player in a lot of different markets. They were, say, the number 4 or number 5 bank in several countries.
And in banking, being small is a death sentence. You don't have the scale.
Scale is the only thing that matters. If you are the number 4 bank in Colombia, you don't have the pricing power on loans. You don't have the technology budget to compete with the big guys. You are just fighting for scraps.
So Thompson came in and made a ruthless call in 2025.
He did.
Yeah.
He sold the banking operations in Colombia, Costa Rica, and Panama. Just boom, we're out.
Now let's dig into the sale, because it wasn't a clean break. They didn't just sell the branches for cash and walk away whistling.
No, it was a very complex transaction, and it came with a heavy, heavy price tag up front.
How heavy?
They took a $1.36 billion impairment loss on the sale.
Wow.
That is a massive hit to shareholder equity. It's basically the bank admitting that the value of those assets on their books was not real. They were overvalued.
That's a tough pill for shareholders to swallow.
Yeah.
But they didn't leave those countries entirely.
No, and this is the clever bit, or the having your cake and eating it too bit.
Okay.
They swapped those physical operations for a roughly 20% equity stake in a combined entity called Davivienda.
And Davivienda is a big player in that region.
A very big player. So the logic is this. Instead of owning 100% of a struggling, small, inefficient operation, I'd much rather own 20% of the market leader.
And that's how Morningstar views it as well.
Yes, Morningstar actually views this favorably, despite the billion-dollar loss. It shifts Scotiabank from being an operator, having to manage branches, hire tellers, deal with local HR, deal with local complaints, to being an investor.
So they get the upside without the headache.
They get a share of the profits if the region grows, but they dramatically reduce the operational headache and the capital they have to tie up in those countries. It cleans up the risk profile.
So they're out of Colombia, Costa Rica, Panama, but they're still in Latin America, right? They haven't completely abandoned it.
No, they're keeping Mexico, Chile, and Peru. But even there, the message is that they're being much more selective. The era of growth at all costs in the South is dead. The focus is now on the North.
And specifically the United States. This has always been Scotiabank's weakness compared to its peers. Their Achilles heel, really.
It is the glaring hole in the portfolio. You look at TD Bank. They're a top 10 bank in the U.S. They have branches all up and down the East Coast.
BMO, too.
BMO bought Bank of the West. They own the Midwest and the West Coast now. Those banks, TD and BMO, get 30% to 40% of their total earnings from the United States.
And Scotiabank?
It's around 10%. And most of that isn't even retail banking. It's niche stuff like investment-grade debt underwriting for big corporations. They have almost no presence with the average American consumer.
So how do you catch up? You can't just go buy a massive U.S. bank like Chase or Bank of America. It is way too expensive. And frankly, the regulators probably wouldn't allow it right now.
And the capital requirements, the amount of cash you have to hold in reserve, are getting stricter and stricter with the Basel III endgame rules. Buying a whole bank is harder than it has ever been.
So Thompson did something different.
He did. In 2024, leading into this fiscal year we're talking about, they bought a 14.9% stake in KeyCorp.
KeyCorp, that's a U.S. regional bank based in Cleveland, I believe.
Correct. A solid, mid-sized U.S. player. Now, that number, 14.9%, is very specific.
Why that number? Why not 15 or 20?
Because if they went over certain thresholds, like 15% or 20%, they would trigger a whole new level of regulatory scrutiny and different, more complicated accounting rules. Staying under 15% keeps it as a financial investment. It's simpler.
It feels like a try before you buy situation, a toe in the water.
That is exactly how the street views it. It allows Scotiabank to dip a toe into the U.S. retail market. They get exposure to the U.S. consumer. They get a seat at the table, a look under the hood.
Without having to change the signs on the branches or integrate two massive IT systems yet?
Exactly. It's a capital light way to say, hey, We are part of the North American story, too.
But is it enough? I mean, 14.9% of a regional bank doesn't exactly make you a titan of Wall Street. It's not the same as what TD or BMO have.
It doesn't. And that is the criticism. It moves the needle, but very slowly. It doesn't instantly transform Scotiabank into a U.S. powerhouse. It's a hedge. It's a way to say they're doing something without betting the entire farm on a massive, risky merger that could go wrong.
Okay. So I want to pivot now to the concept that really underpins all of this. We have talked about the numbers, we have talked about the map, but we need to talk about the economic moat.
Yes.
This is a core Morningstar concept, and I think it explains the Scotiabank dilemma better than anything else.
I love the moat framework because it ignores the noise of quarterly earnings and just looks at the structural advantage a company has.
So define a moat for us.
A moat is simply a barrier that protects your profits from competitors. You have a wide moat, you can charge more for your product or operate more cheaply, and nobody can really come in and steal your customers.
And in banking, that moat usually comes from two things.
Right. Primarily, yes. Switching costs and cost advantages.
Okay, so Morningstar gives Scotiabank an overall rating of narrow moat. But it is really a tale of two banks, isn't it? It's not one cohesive story.
It is not. You have to break it down segment by segment. Let's look at the Canadian banking segment first. This business absolutely has a moat. In fact, if it were a standalone company, it might even be a wide moat.
We often call it the Canadian fortress. It's this protected ecosystem.
It is a protected garden. The big six banks, RBC, TD, Scotiabank, BMO, CIBC, National, they control over 90% of the banking assets in Canada.
90%.
It is an oligopoly. It's one of the most concentrated banking systems in the developed world.
And the government, the regulators, they help keep it that way?
Hugely. Federal regulations effectively block foreign takeovers. You can't have JP Morgan or HSBC just waltz in and buy Scotiabank. It's not allowed.
It protects them from real global competition.
It does. Plus, the capital requirements to start a new bank from scratch are incredibly high. So the big six don't really have to worry about new entrants stealing market share.
And then there are the switching costs you mentioned.
This is the other side of the moat, and it's maybe even more powerful.
Explain that.
Think about your own bank account. You have your payroll direct deposit set up. You have your mortgage payments coming out. Your credit card is linked to it. Your Netflix subscription auto pay. Your hydro bill.
It's a spider web.
It's a massive spider web of financial connections. To switch banks, you have to undo all of that and set it all up again somewhere else. It is a massive hassle.
So even if another bank offers me a slightly better interest rate on a savings account, I probably won't switch because the pain of doing it isn't worth the small gain.
Exactly. That is switching cost in action.
Yeah.
And because of that, because customers are sticky, the Canadian banking segment consistently earns a return on equity, that ROE, above 20%.
And the cost of capital, the return investors demand, is what?
It's only about 9%, so they are generating massive excess value. They are printing money inside the castle walls.
Okay, so Canada is the fortress. The moat is wide and deep. Now let's look at the international segment. Morningstar rates this as having no moat.
0. None. And this is the structural problem that has dragged the bank's overall returns down for years. You cannot simply take the Canadian playbook and drop it into Peru.
Why not? Why aren't the switching costs the same there? People still have direct deposit and bill payments.
They do, but Scotiabank isn't the incumbent. In Canada, they are the giant. They're the establishment. In Peru or Chile, they are the challenger.
They're the foreign entity.
They're the foreign entity fighting against global giants like Spain's BBVA or Santander, who are much bigger and have much deeper roots in the Hispanic world. They're also fighting local heavyweights who have been there for 100 years.
So it is a street fight, not a cozy oligopoly.
It is the Wild West. Margins are compressed because competition is fierce. You have to spend more on marketing just to get customers in the door, and the risk is higher.
How so?
Well, the cost of equity, what investors demand for taking on the risk of being in an emerging market, is higher. It's around 11% or 12%. And Scotiabank, in many years, often barely earns enough to cover that cost.
So they're running on a treadmill just to stand still.
In some of those markets, yes. That's a great way to put it.
This explains the divestiture strategy perfectly. Why keep fighting in a no-moat jungle when you can retreat to the moat of North America?
That's the entire strategy in a nutshell. Shrink the no-moat business and reinvest that capital into the moat business.
There is one other area with a moat we should mention, though. Wealth management.
Yes. Global wealth management has a distinct moat. This is a relationship business.
Very sticky.
Incredibly sticky. If you are a high net worth individual, You don't switch your financial advisor just because another bank offers you a free iPad for opening an account. You trust your advisor with your life savings.
And Scotiabank made a really smart move a few years back, acquiring MD Financial.
A brilliant move.
Yeah.
MD Financial serves one group and one group only: physicians, doctors.
A very desirable client base.
A super sticky, high-income client base. They have very complex financial needs incorporation, tax planning, insurance. And once you have them as a client, they rarely, if ever, leave. That business is a rock.
So, okay, the plan is logical. Retreat to the fortress. Focus on sticky wealth management. Dip a toe in the U.S. But logic implies the world behaves the way you want it to.
And it rarely does.
And looking at 2025 and early 2026, the world has been uncooperative, let's say. We have to talk about the macro risks, specifically tariffs.
The tariff scare of February 2025.
Yeah.
It feels like ancient history now that we're a year on, but we have to remember the panic in the market at that time.
Refresh our memory.
The U.S. administration, the Trump administration, announced it was seriously considering 25% tariffs on all Canadian and Mexican goods.
This is the absolute nightmare scenario for a bank that is betting its entire future on the North American corridor.
It attacks the very premise of the strategy. It's like building a beautiful bridge and then having someone threaten to blow it up.
If you were building a bank based on the free flow of trade between Mexico, the U.S., and Canada, and you're building this corridor for your clients to move money and goods, and suddenly massive walls go up.
Your business model breaks. The whole thing grinds to a halt.
And Scotiabank is more exposed than any of its peers.
Far more. As we said, Scotiabank earns about 13.5% of its income from Mexico. The other Canadian banks, almost zero.
So when the U.S. threatens Mexico with tariffs, which seems to be a constant feature of the political climate, Scotiabank's stock takes a direct hit that the others don't.
It's a unique vulnerability. It's a double whammy. If the U.S. hits Canada with tariffs, all banks suffer because the whole Canadian economy suffers. But if the U.S. hits Mexico, only Scotiabank really suffers among its peers.
And did we see that reflected in the analyst ratings?
We did. Morningstar actually raised the uncertainty rating for all the Canadian banks to medium during that scare.
Because of the recession risk.
Because if those tariffs stick, Canada almost certainly goes into recession. Unemployment goes up. Businesses fail. And remember those provisioning costs we talked about?
The bad debt jar.
If Canada goes into a deep recession, that jar isn't big enough. Provisioning would have to skyrocket. We are talking about potential insolvencies on a massive scale.
And that leads us directly to the other perennial Canadian fear: housing.
The elephant in the room. Always.
We all know the story. Canadian households are leveraged to the hilt. Some of the highest debt-to-income ratios in the world. High mortgage debt. But there is a surprising detail in the Morningstar report about Scotiabank's specific exposure here.
It is surprising, and it goes against the common perception. Scotiabank actually has the lowest relative exposure to the Canadian housing market among the big six.
Really, that is not what I would have guessed. I feel like they are always pushing mortgages just like everyone else.
They are, but it's a denominator effect. Because they have that big international chunk and the large global banking and markets arm, the Canadian residential mortgages make up a smaller percentage of their total loan book compared to, say, a bank like CIBC.
Right. CIBC is basically a giant mortgage machine with a bank attached.
That's a fair characterization. So on a relative basis, Scotiabank looks a bit safer.
So theoretically, Scotiabank is safer if the Canadian housing market crashes.
Theoretically, yeah, in relative terms. But here is the bear argument, the pessimist's view.
Okay.
Scotiabank is actively trying to grow its mortgage book right now. They've stated that. They want more market share in Canada because it's just the moat business they want to focus on.
So they are leaning into the housing market just as the economy is getting shaky.
They're growing into a potential downturn. That is a very bold move.
Or a reckless one, depending on how it plays out.
It could be. If unemployment spikes because of those trade wars we mentioned, credit costs will soar across the board. It doesn't matter if you have slightly less exposure than CIBC. If the Canadian consumer collapses, Scotiabank feels significant pain.
There's no hiding from a systemic crisis.
None at all.
Okay, let's bring this all down to the bottom line then. We have a bank in transition, we have a solid Canadian fortress, a shrinking international footprint, and a recent sugar rush of fee income. what is the stock actually worth?
This is where the rubber meets the road.
So as of the end of fiscal 2025, in December, the stock was trading around what, $96?
Roughly 96 Canadian dollars, yes.
And what does the Morningstar model, after crunching all these numbers, say it is actually worth? What is the fair value estimate?
$78.
78. That is a huge discrepancy. You are paying a nearly $20 premium per share above what the analyst thinks it's intrinsically worth.
The price to fair value ratio is 1.23. You are paying $1.23 for what Morningstar believes is $1 of value.
So the verdict is clear. Overvalued.
By their metrics, yes. Significantly.
Why? Is the market crazy? Or are investors seeing something that Mai-Wen Chen and the Morningstar team aren't?
Well, markets are often forward-looking, sometimes to a fault. The market sees that EPS growth of 23% and thinks the turnaround is here, the rocket ship is taking off, the North American strategy is working.
And Morningstar saying, hold your horses, not so fast.
Morningstar is saying, look at the quality of those earnings. That growth was fee income. It was volatile. They believe it's hard to repeat in 2026.
What?
Meanwhile, the core banking business is barely growing and provisioning costs are high. You are paying a premium price today for a turnaround execution that hasn't fully proven itself yet. You are paying for perfection in a world that is very, very imperfect.
And it is not just Scotiabank, right? Looking at the peer comparison in the report, this seems to be a sector-wide phenomenon.
No, the whole sector got expensive toward the end of 2025. You look at RBC, Royal Bank, its fair value is 169 and it was trading at 214.
Also very overvalued.
TD Bank, fair value of 83, trading at 119. BMO, fair value 151, trading at 173.
So there's a pattern. The whole sector looks expensive right now relative to intrinsic value.
There's a general sense of exuberance in the Canadian financials that the underlying fundamentals don't quite support, according to this analysis.
What about the dividend, though? For many people, that is the whole reason to own a bank stock. It's the safety net.
The dividend is attractive. The yield is around 4.5%, and that absolutely puts a floor under the stock price.
Why is that?
Because income investors, pension funds, retirees, people who need that steady cash flow, will always be there to buy the stock for that yield. It is hard to find a relatively safe 4.5% elsewhere. So it provides support.
But we always have to check the sustainability of that dividend.
Yeah.
And that brings us to one last metric I want to touch on, the efficiency ratio.
A crucial one. A measure of how good management is at controlling its own costs.
So simply put, how many cents do you spend to earn $1 of revenue? Lower is better.
Exactly. And Scotiabank has a stated goal to get this ratio down to 50%, spend 50 cents, make $1.
Which is the gold standard for a large bank. But where are they now?
Well, Morningstar's forecast says they're not going to get there. They forecast that they will settle around 55% or 56%.
That is a big miss. That is a 5 or 6 cent difference on every single dollar of revenue. Across billions of dollars in revenue, that is a massive amount of money being left on the table.
It is. And it's because expenses are sticky. They are spending heavily on technology to modernize the bank. They're paying out big variable compensation bonuses for that record performance in wealth management and capital markets. Yeah. And general inflation drives up wages and other costs.
So the analyst calls that 50% goal what?
Very ambitious and ultimately unlikely to be met in the medium term.
And if you can't get more efficient, your profit growth is capped. You can't just keep raising fees on customers forever to make up for it.
Exactly. If the efficiency ratio stays high and the provisioning for bad loans stays high, that exciting earnings growth we saw in 2025 is going to disappear very quickly.
Okay, so let's wrap this all up. We have covered the numbers, the strategy, the moat, and the risks. If we have to summarize Scotiabank in early 2026, it is truly a story of a bank trying to find its way home.
It is a massive, ongoing restructuring. They're cutting off the limbs that weren't working, selling those small, no-moat Latin American operations, and they're trying to graft on a new limb in the U.S. with that Key Corp stake.
They're retreating to the safety of the North American castle.
That's the plan. And the moat analysis we did shows us why they had to do it. You can't win a war without a moat. The old international strategy was structurally flawed because they simply had no durable competitive advantage in most of those markets.
Correct. But here's the provocative thought I want to leave with the listeners.
Okay.
The entire strategy is to retreat to the castle, the North American corridor, because it is supposed to be safer. It is supposed to be the moat.
Right. That's the whole point.
But is it? Look at the geopolitical world we live in right now. Look at the headlines every single day. Tariffs, trade renegotiations, Political volatility in the U.S. Protectionism is on the rise globally.
Re-globalizing world, as some call it.
Exactly. Is that castle actually safe?
That's the billion-dollar question.
Yeah.
Scotiabank is betting its entire future on the stability and the free flow of trade between Canada, the U.S., and Mexico. They are betting on that corridor remaining open.
But in this new world, that specific link might be one of the most fragile, politically sensitive points in the entire global economy right now.
So have they pivoted out of the jungle and straight into a hurricane?
It could be. Is the safety of the corridor an illusion? That's a heavy thought.
It is. The corridor might be a wind tunnel. And for investors paying $96 a share today, you better hope that tunnel holds up.
Something to chew on as you watch the headlines in 2026. Keep an eye on that efficiency ratio and definitely keep an eye on the trade news.
Always.
Thanks for listening to The Deep Dive. We will catch you on the next one. And, as always, remember, none of this is investment advice. Do your own research.
Take care.